So, welcome to The Raise. I'm your host, Jade, and I'm really excited to be here today with our guest, Tom, who is the co founder of an AI growth intelligence platform. So, they're using AI to help companies better understand their customers, predict behavior patterns, and reduce the risk of running the wrong product experiments that can be a waste of time and money. They've just closed a pre seed round, and today we'll talk about how they made that happen because that's a huge amount to close for pre-seed, and learn from the experiences as well. So Tom, welcome and thank you for joining us today.
Thanks very much for having me.
No, that's fine. But also before we get into questions, just a quick heads up for everyone that's listening is that Tom and his team are currently building their startup in stealth mode. So for those who are unfamiliar with that term, it basically means that the product is being built privately. So we won't be referring to their company name during the conversation today, and that's why. But Tom, first, it would be great if you could tell us a bit about your background and why you started the business in the first place.
For sure, for sure. So yeah, I'm Tom. My background's in data science. I've been building companies for the last decade. I cut my teeth working on kind of high risk environments, building artificial intelligence models in high risk environments. Then went on to kind of build a few startups. Have built a company in the travel tech space, built a company in the ed tech space. Um, and I think one of the reasons that we started building this company is one of the big problems we've had in the past has always been around trying to work out which experiments we should be running. You get to a kind of a certain size of company and you start thinking about A/B testing, and 9 times out of 10, you're just working with a homogenous blob of data. You just
Mm,
don't really understand like how your customers are broken down. Yes, there are things out there like segment and stuff like that, but they're just not doing a very good job at segmenting your audiences by not just how people are using your product, but who your users actually are. So the thing that we're doing is
mm,
trying to kind of make that a little bit better and yeah, I guess kind of add psychographic profiles to your customers. And then use that to just make sure that product teams are able to run better experiments. And by that, I mean, like, right now, product teams, they spend 2 weeks scoping, 2 weeks kind of
mm,
building, and then 2 weeks or more waiting to see if the experiment's worth rolling across the whole user base. The approach we're taking is by building out these synthetic behavioral profiles, we can predict how customers are likely to behave. So you as a product team can say, I've got 10 experiments I want to run. How are they going to essentially perform? But more
mm,
importantly, how are different customers likely to perform?
mm,
And the reason that we're doing all of this is because the long-term goal for us is to get to the point where we've got adaptive user interfaces. And by that, I mean like your version of Uber and my version of Uber could be two fundamentally different products based on who we are as individuals. There's a whole bunch of good things that it does. Yeah, accessibility, like the example I give, like apologies to my dad in advance for this, but him using Uber and my using Uber are two very different experiences. So why are we being given the same product? That's kind of one of the things we
mm.
ask ourselves a lot. So yeah, that's kind of what I do now. As I say, built a couple of companies in the past. I do a little bit of angel investing. I've done a whole bunch of things from kind of giving TEDx talks on AI to advising the EU Parliament on GDPR in the early days. Yeah, have kind of been around the block for a while, but excited to be now spending most of my time in San Francisco building out there, and seeing what will come of this one.
Yeah, I mean, a lot, it sounds like there's a lot of experiences that your product can fix. And as a founder that is building something, just being able to understand, okay, if users may behave this way, or this is more likely to help their experience and guide them in a particular way, that's a huge win for the people on the receiving end of it. So it sounds like an amazing product that's being built.
No, I appreciate that.
Yeah, and it must be exciting to be over in the States for a bit as well.
Yeah, definitely. It's the last two companies I've built have been in the UK. And I feel like you come to a certain size, like we've come to a size before you end up flipping into a US entity.
Mm,
It just costs so much money. And we just said this time around, like instead of the 50 to $100,000 that we'll end up spending when we have to become a Delaware C Corp, we'll just be a Delaware C Corp from day one. And given the like hype in San Francisco right now around artificial intelligence, I just felt we were doing ourselves a disservice by not being there. So we made the
yeah.
decision to go over there and just see how it all pans out, basically.
No, that's fair. And I mean, it's something that's also something for founders to consider. A lot of people do raise where they are, but that isn't the only option that you have to go for. You can also go, given if your situation permits, not everybody's in a position to, up and leave. But if you're in that position, it's an option to say, actually, I'm going to go and live in a place that will be like more beneficial for me to be raising in.
Yeah, 100%.
So saying that, we get into some of the fundraising questions. It'll be great to know, what stage were you at with your product before you started fundraising?
So we've been through a couple of kind of pivots. So actually, the product started quite differently. It started as a PCRM, a personal CRM. We were thinking just a bit about how like we maintain relationships better, how we make it easier for people to connect. And I think like we went through that process. Clay is a good example of a company that does that.
Yeah.
Clay recently came out with, or I guess not so recently now, came out with something called Clay AI, which was really kind of what we were building towards. And I think it's still an interesting space and yet to be solved. But the problem we had is we built an MVP of it. We got to the point where we were giving it to customers and getting them to try it out. And, people loved it. We built out a good wait list and got people using it, but people just weren't prepared to pay for it. And having built a
Ah,
couple of companies, I was just kind of like, I don't want to build another company where like we're thinking about revenue for too long. If we're going to build another company, this one has to be making revenue from the off.
right.
So we went through that process a little bit. I was doing some consultancy from a data science perspective at the time as well, just to kind of keep afloat. And one of the projects that I did was very much around predicting whether a customer was likely to convert from free to paid within 24 hours. Um,
Oh,
the reason for that is because they wanted to feed that data back to Google, and then basically get more of those customers coming through and less of the ones that don't convert. Um,
right.
it worked well, but the biggest thing that I found going through that process is the customers with the highest LTV, the kind of the whales, as you might call them, they never even made it into the trial because the onboarding wasn't quite there. And that got me thinking a lot more about product in the sense of, is this a kind of a standalone use case, or is this something that happens a lot? And having spoken to a bunch of product teams, the thing that we learned was a lot of people are thinking about the local maxima instead of the global maxima. And by that, I mean thinking about the short-term vanity metrics of, oh, conversions are up, so everything's moving in the right direction, not really
Right.
realizing that 6 months down the line they'll be in a bad spot. So we kind of like we got to there, we started building out a product, built out a wait list of 60 companies. We paid proof of concept, and then we started raising. So we had the
Ah,
model, we had some of the kind of tech, we didn't have a fully built product, and then we started raising. But at the same time, we're continuing to build out the product while we raised.
yeah. And I mean, having that list of 60 potential customers, they've shown like that propensity to spend, and you understand your revenue model as well. Starting to fundraise in that position is also that puts you in a position of strength.
Definitely, it makes life a lot easier. I mean, there's definitely been questions around how much should we raise and kind of some of that stuff. Given that we're largely based in the US, it is just it's more expensive to be there. I think, I think back to kind of before I was out there, and everyone thinks of the like raises in San Francisco as being big rounds,
Mm.
but when you think that I've met engineers that are on over 900K a year, suddenly it makes it more understandable as to why teams will go out to raise anywhere between kind of, I don't know, 1 and 5, I guess is probably the market at the moment for their
Wow.
pre-seed, and obviously raise more later down the line.
I mean, never heard that number for an engineer before. That is mind blowing.
Yeah. Yeah. I mean, admittedly, that was kind of like a fairly senior ML engineer, but like, you know,
Okay.
OpenAI are paying their top engineers over $1 million a year.
Oh,
It's just crazy.
oh my gosh, I went into the wrong field. Yeah, maybe in another life I'll be an engineer, but no, that's really interesting to hear like that experience. It seems like it's been very different in the UK versus the US.
Yeah.
So it'll be good to hear, like, as you have raised in both,
Yeah.
what are the core differences that you've seen between kind of like UK investors and US?
So I think one of the big things here is the kind of mentality of, and we all know the mentality of like Europeans are more conservative than Americans.
Mm.
That's very much true, and that's definitely kind of one of the things that I learned from being out there. But I think that just kind of like blends down into the whole process of fundraising and building a product. The American way of thinking is much less about where are you at now, it's much more about where are you going to be in the future. So I think when
Mm-hmm.
we first started raising, we were less focused on how do we get to adaptive user interfaces as the kind of the pipe dream, the long-term vision, and much
Yeah.
more about how do we get to the point where we can help product teams run experiments like synthetically in how can we build simulated environments to allow them to run those experiments. And that got people excited, but it didn't quite get them there. And then when you
Right.
started talking about the market size of adaptive user interfaces and the fact that if we get this right, every digital product in the world would potentially need our product, the market
Mm-hmm.
becomes much bigger, the vision becomes much bigger, the opportunity becomes much bigger, and that gets people excited. And I think that's kind of the first thing that I've noticed. I think the second thing that I've noticed since being there is just generally speaking, there's a lot more capital. Now,
Mm-hmm.
the markets haven't been amazing. It's still hard to raise, of course it is. Um, but there is just more money out there. You know, in the UK or even in Europe, there's probably 15 to 20 funds I can talk to. In San
Right.
Francisco, there's probably 100.
Wow.
And
Okay.
that's kind of like one of the things to take into account. And I think the third thing that kind of I've noticed in the difference between the UK and the US is I mean, ignoring the fact that we're more modest as a culture here, which is, you know, we can talk about the fact that like everyone wears their CV on their sleeve in the US. That is definitely the case. But I
Okay.
think because we're more modest and because we're more kind of conservative, even founders open their book less for other founders. So it's one of the kind of like shocks I had when I came back and spent a bit of time in the UK. Immediately, all I wanted to do was help all of the founders that I knew, introduce them to
Yeah.
people, do what I can to support them. And it's not reciprocated in the same way that it's reciprocated in the US. In the US, everyone just does everything that they can everything they can to help one another. And I think partially it's because there's enough capital out there that people don't feel like they're at competition with other founders. So everyone just
Right.
wants to see other people succeed and kind of work together. And I felt that less when I was in the UK.
That's so interesting. It's really interesting to hear because I hear that in different types of communities in the US and the UK as well, not just founder, but even when you're talking about like the support that minority communities give each other. A lot of the time I'll hear them say you get much more of that in the States than you do in like the UK and Europe too. So it feels like that's like an energy that exists kind of across the board.
Yeah,
Um, and I guess that's something for other founders to bear in mind is, you know, what can we do as a group of people to build a community that's super supportive? Because fundraising is hard enough as it is, you know, and you don't want to feel like you're in it alone. I think there are a lot of founders that feel that kind of loneliness and that
for sure.
strain when they're in the middle of it.
Yeah,
And if we can do more to support each other, we alleviate that weight.
100%.
So no, thank you for that. And you touched on this a bit earlier about you know, how much you've raised, and you know, you raised a significant amount for pre-seed. A big question that founders often have is how do they determine how much they should be raising? So can you walk us through how you and your team landed on that figure?
So there's two things you think about. There's the first, which is what's the market saying? 2 at 10 in San Francisco at the moment is kind of normal. You know, you get some people that do slightly less and some people that do slightly more, but 2 at 10 is very much the kind of you know, that's the pre-seed amount. And yes, that's kind of slightly inflated, probably due to the AI curve that's currently going on.
Yeah,
Um, but like I know, I reckon I could list off 5 or 6 friends that are all raising 2 at 10. That just is the kind of normal amount. And you know, naturally valuations will fall somewhere north or south of those things, but that's kind of gives you a good benchmark. So I think that's kind of the first step. The second step really is kind of thinking a bit more about like what you really need. So for us, we need to think about where did we want to get to before we next go out and raise money? What is it that we need to prove? And I think for us, we had the basic product working. We had our first customers, you know, kind of ready to come and join the platform who have now joined. And generally speaking, we knew we had a benchmark of where we wanted to get to before we go out and raise our seed round. And from there, you can kind of begin to backtrack and think, okay, if this is how much money we need, who do we need to hire? What do we need to do to get there? Then that just gives you kind of a benchmark. And generally speaking, once I've worked out what that number is, I'll add another kind of 20 to 30% on top just in case things are running slow.
Yeah.
And because inevitably fundraising always takes longer than you expect it to. So giving yourself that extra 30% gives you maybe an extra 3 to 4 months of runway as you approach the next raise.
Yeah, that makes sense. And it one with valuations, one of the things that I've found is if you look at some of the data, there are people from Carter, I can't remember his name, I think it's Peter Walker on LinkedIn who shares like some really incredible data because Carter aggregates all of that. There are ways that you can get kind of like rough ballparks for your industry, for your stage, and that can help people find like roughly where they should sit. But
Yeah.
it is that kind of like that understanding of what is the expectation. Some investors will question you if you don't raise enough.
Yeah, 100%. Yeah, 100%.
Um,
And the other thing to think about when it comes to valuations, my rule of thumb, never more than 20%. Um,
okay.
unless there's some sort of strange circumstance where we're really struggling to raise money, never more than 20% for your first round because, I get that like you don't want to be greedy, but realistically, if you're giving 20% away for each round, by the time you get to kind of Series B, Series C, assuming that you need to go and continuously raise rounds, you're not
Right.
going to with much of the company.
Yeah.
So I think actually the kind of rule of thumb in San Francisco is never more than 10%, but obviously the European mindset is never more than 20%. So generally we aim to fall somewhere between the two, so somewhere between 10 and 20% is what we were targeting for our round.
That's really good for people to hear that that expectation is different in different parts of
Yeah,
the world.
100.
Because I think the assumption that, and it's based on what people hear over and over again, is 20%. I've never heard anybody say 10.
Yeah,
So I think there's a big thing on research and just trying to understand based on the investors that you're going after,
yeah,
what would their expectations be? Um, but yeah, evaluations always feel like a sticky one. I think it took me a good couple of months to be like, oh, I feel confident now.
yeah, yeah,
I've landed
yeah.
on the right number. That can be hard, but thank you for sharing that because I feel like that's super valuable. And based on what you've currently been through, what are, say, two or three other things you think founders need to consider this as they prepare to fundraise?
So honestly, the one thing that you need to spend time doing is building your network. We made the decision to move out to San Francisco. We had some friends there, but not many. The first 2 months of being there, we spent just making friends. Because the whole, I was sat down with a VC, and the exact conversation was, and obviously take this with a pinch of salt because never really like trust the no, but don't trust the reason is the kind of common phrase. But
Mm.
I mean, we never actually got a no from this person, but the statement was, I really like you as a team, and I really like the problem and the market size that you're solving. The big
Mm.
problem I've got is I can't back channel you against other people within my network because you didn't go to Stanford University and you didn't go and work at a fan company for 5 years. So I can't ring up the founder of a company that you've worked at and say, hey, what do you think of Tom? Now, like, first of
Ah,
all, like, it's pretty crappy behavior, in my opinion, to say that because it's
mm.
just virtue signaling. And that's kind of one of the big goals at some point I want to change. That's kind of one of my big things. I'm very, very passionate about fairness, and I don't understand, like, I don't understand why that's a thing. Now, maybe founders that go to Stanford do index more towards success. Like, I don't know. I don't
Mm.
have the metrics on that, but because I didn't have the network and because I wasn't able to essentially say, well, go and speak to my friend Joe, who can give you a good reference about me and, essentially say that I can execute, because that was the problem. Was they said, oh, well, we don't know whether you can execute yet or not because we don't know you well enough. And even when I explained that I'm an exited founder, the immediate answer to that was, but you're a European exited founder, and it was a European exit.
Ah,
Um, so there's just a kind of way of doing things there, which is, although people are prepared to help each other much more on a shallow level, the
yeah,
deep level is where you need to spend time building community. And I think that transcends across like every network, every country, and to be honest, every fundraising cycle. Spending time getting to know the community, getting to know the VCs that you want to raise money for is important, and we will say it.
yeah,
But the reason I think it's particularly important just is because you have to have people that can trust you. At the end of the day, it's a partnership. I totally understand why the VC said what they said. I don't think it was
hmm,
particularly well put. Um,
yeah,
but I think that's one of the key things that founders need to be thinking about when they're trying to go out and raise money.
yeah. And it's It's one of those things that's hard because it happens everywhere, right? People always say it's who you know.
Yeah,
Not necessarily how good you are, what you do. It's definitely a lot of it is who you know, and getting those warm introductions or those like recommendations or those kind of like that reassurance from somebody that is connected with you, that goes a long way to helping you be able to close, especially when people are kind of like giving up the larger the sum of money, the more the risk, the more they're
yeah,
going to want to check.
of course.
So that it's like it make the question make sense, but at the same time, it automatically creates this unfairness, like you said,
Yeah,
and it makes the disparity between those who have connections and those that don't even greater.
yeah, 100%. It's one of the reasons why I've always had quite a lot of respect for Y Combinator because, you know, yes, you can be referenced by other founders that have been through the program, but at the end of the day, everyone is filling out the same application. That same
Yeah,
application is being marked by the same people. So everyone has an opportunity, which is why when you look at YC's, kind of portfolio of companies, you've got founders from all over the world. You've got founders from Nigeria to, Japan. There's a complete range of founders.
mm,
Because they're given the opportunity. They don't have the network in San Francisco, but they put in the application. They've got a good idea. Why is he prepared to back it? I think there needs to be more of that
mhm.
in the venture capital world than there currently is. But obviously, I'm very aware that YC is lucky that they've made some very big and successful bets, which means that
Yeah.
they can now afford to take some of these bigger risks.
Yeah, and I guess it's when you're making changes like that they're systemic changes, right? There's systemic issues that need to be changed. It's not something that will happen overnight, and it also requires enough people trying to fight the cause
Yeah,
to
100.
to create that change and make it more of a level playing field.
Yeah.
So no, I appreciate that's a really good piece of advice for people. Is like building your network is definitely something to double down on. Um, and then other than that, what were some of the early decisions that you and your team made about the type of investors that you would approach? Because there's lots of ways you can raise. You can go for angels, you can go for VCs, you can crowdfund, you can get debt. So what did
Yeah.
you decide to do as a team?
So I think, we had some pretty outrageous offers from the debt side. Outrageous in a good way, but just maybe would overbloat the company. Something that we have to kind of think about. We had, a whole range of different options to choose from. The route that we went for was a combination of VC and angel. VC because it just opens up doors for future raises, and generally speaking, like, look, the best founders don't ever ask for help from their VCs, but at the same time, having people that understand your industry is definitely helpful. So the approach that we took was twofold. We found some of the best angels in artificial intelligence, in product development, and in behavioral economics. We
Right.
identified who those people were and started building relationships with them to kind of see if they got what we were building. Because again, if you can pitch the angels and they get what you're doing, then chances are you're probably building something that makes sense.
Yeah.
So sense checking with them initially and kind of getting those involved. Once we had those, of course, some of them made introductions to VCs for us.
Mm,
But it was a case for us of instead of targeting the tier one funds, the kind of usual suspects, we were very much thinking about who are the founders of VC funds that have the deepest tech experience, because the space
okay.
that we're building in, while not a foundational model, is obviously still in the AI space. It's still very much focused around behavioral science. There is still technical risk involved, and to some degree, it's frontier tech. So we
Mhm.
wanted to make sure that we had people behind us that really got that. And the reason for that is because, and kind of, I'm hoping that I don't piss off every VC that fits this mold. When the AI curve really started to pick up,
Mm.
I mean, everyone switched from if I the number of crypto funds that were suddenly AI funds was fairly laughable. But even your generalist funds were starting to invest quite heavily into AI. And I think the problem
Yeah.
with that is not that they don't understand the space; it's that they don't understand the expectations of the founders.
Hmm.
With AI, for example, it takes time to build the technology.
Yeah.
And there are a number of VCs that have spoken to friends, even spoken to myself about building this AI company, and they want product and they want revenue from pretty much day one. And
Mm.
yes, it's possible if you're building a simple like wrapper on top of GPT or something similar, but that's
Yeah.
not easy if you're trying to build some deep tech.
Yeah.
And we've been fortunate that we have been able to make revenue, but the focus for us was how do we make sure we've got the right people around us so that we can approach building this company in the right way.
Yeah. That's a huge, huge thing for people to consider because not all money is, is good money. You
Yeah,
shouldn't always take money from people just because they have it. You have to find the right type of investors. Like you said, understand the process because you can't fast forward building,
yeah,
a platform like yours. That's
yeah.
going to take time and patience. And if you don't have investors that recognize that, you're going to be fighting back and forth with over things that you just shouldn't be spending your time talking about.
Exactly. Time and money and just general stress that the founder doesn't need in the early stages. So that's kind of, yeah, for us, why I think just thinking about your investors is really important. And to be honest with you, in the past I wouldn't say have been burned, but we've definitely had the wrong investors in companies that we've built in the past, which is why this time around we said, even if it takes us longer this time, let's just put the effort into finding the right people for us because we will look at eventually get there. The one thing I say to all founders is if you're raising long enough, you will find the right investor. They will come to you at some point.
Yeah. And I guess it's in this climate in particular, where I mean, the world has kind of financially been on fire for the past
Yeah,
couple of years. So it's taking people longer to close around. I've heard people say anywhere from like 8 months to just over a year
yeah.
to get those people together. And so that's a good question. How long did it take, your team from the moment you said, let's go out there, let's build these relationships with people to when you closed? How long did that take?
So it's about 3 months, 3, 4 months. We were quite quick, but I'm obviously very aware that, we're exited founders with very clear founder market fit from kind of that perspective. So I think we did have a leg up in that perspective.
Yeah.
I'm very aware of that privilege from that perspective. I think the other thing is we've got good angels that have invested in the companies previously, so being able to rope those in from day one also made it easier for us to raise money.
Okay. Now I mean, that's fair. You've been through the process a few times, so it's supposed to, if you decide to go on and build another thing, the
Yeah.
process should be a bit easier and a bit faster because you've been there, done it, and worn the t-shirt. Um,
To put
but
that into
going,
perspective, I will say quickly though, like in the past, the first round we ever raised, we did in a week.
wow,
The for the and generally speaking, we'll range from kind of somewhere between like a week to 2.5 months. So this was the longest raise for us.
wow.
It took the longest amount of time to raise. And as I say, I think a big reason for that is because we basically spent a bunch of time out building the network before we actually tried to start raising money.
Yeah, that just goes to show the importance of doing it. Imagine if you had done it without going through that process of
100%.
trying to speak to those people.
Yeah, we would still be raising now.
I think that's half of it. One of the best pieces of advice I've had is don't speak to people when you need money. Actually build your network, speak to people beforehand. So by the time you're ready to have that conversation, they already have a history of who you are. They know you, they know your products, they know the industry a bit better because of you.
Yeah,
And that makes the conversation much easier.
yeah, 100%.
So no, I appreciate you sharing that as well. And so for those who are going through it for the first time, um, how could you explain like how you went about finding investors and like kickstarting that outreach? Because that seems to be the kind of the most difficult thing that I see founders trying to manage right now is let's say they've gone through it, they know how much they want to raise, they have a roadmap, but it's like, okay, where do I go and find these people and how?
So there's a few bits out there. Like, I guess I'm slightly biased given that this is, I've raised multiple times before this one, for other companies. When there's a few things that you can do. There's a book by I think his name is Ryan Breslow. He's the founder of a company called Bolt, which is not the taxi company. It's a company based in the US. He wrote a book that was about like how to fundraise, and it's a pretty good book. one of the things that he did, which I didn't actually realize because I did it just naturally, and then someone basically said to me, "Have you read his book?" One of the things I did as soon as I arrived in San Francisco was started hosting dinners. Hosting dinners on a monthly basis for early stage founders who are similar to me, who can basically come together and begin to help each other. Now, there's probably about 1,000 dinners going on a night in San Francisco. They really are just everywhere, because
Wow.
everyone knows that building your network via dinners is a good way of doing things. But that would be one of the first things that I started doing. And, we did that for this round. We then went out to South by for the, for in Austin for the conference. We ended up hosting a dinner there. We had 1,500 people apply for a spot, and had 12 seats because I was hosting it in our Airbnb. So there was literally like, we do all the cooking, we bring the people together. It just makes it more intimate and more enjoyable. But because of that, we were able to just bring in some incredible people. So the founder of Slush, who's now building an incredible company called Singer. There was a couple of unicorn founders. Really good conversation to just be had that evening, which then as
Mm.
I came back into obviously San Francisco, that opened doors from that perspective. So I think that's one thing that you can certainly do to begin to build your network if you've got the capabilities to host a dinner. And it's something that I will continue to do just because the actual reason that I started building my community is I wanted to find a way for people to come together and switch off. There's a community that I'm part of in the UK called Founders. I joined it when I needed it most, and it had a huge impact on my life. I
Mm.
realized there was nothing like that in San Francisco and wanted to try and bring some of that across to the wider Bay Area. Um, so that's kind of the first thing to think about. The kind of other things you can do. Obviously, you can attend events. I don't think I've ever found anyone particularly useful out of an event, but it does just mean you're well
Interesting.
networked. Um,
Yeah.
I think the best benefit that comes out of just going to events is you're pitching a lot. So you're refining your pitch more and more, finding the thing that's going to stick so that you know how to pitch the product when you're speaking to investors. I think when you start speaking to investors, the way that we always line up our meetings is start with the worst investors or ones that just aren't a good fit for our product, so that we can
Mm.
test the pitch on them, refine it, get it right, and then by the time you're getting to the ones that you really want in the round, generally speaking, you can you can give the best possible pitch. But I think the reason that, like, again, I go back to community building and just kind of finding people that you can work with. The reason that that's important is warm intros, especially in San Francisco, are fundamentally the most important thing. We haven't done any cold outreach for our round because it just wouldn't have had any impact. There isn't a single person that I've spoken to that hasn't come referred to me by someone that I already know. And I think the reason for that is just because I know so many founders that send thousands of cold emails to people. And I've also heard stories from VCs that say, hey, do you know what? We've got the application form on our site. If anyone fills that out, we probably don't take it that seriously. Again, big problem that exists in the industry that needs to change. There are some people that, of course, put that on their site because they genuinely want you to fill it out in the same way that YC has an application form. There are
Mm.
also a lot of VCs out there that have it on the site to almost just kind of like sense check, in the sense of, if you filled out a form on the website, why haven't you gone to the effort of finding someone that they know that can do an intro? I think it's flawed, but that is just the way the industry is right now.
That's so interesting to hear because I mean that kind of dovetails quite nicely to the next question, which was, we often hear the warm introductions are much better than cold outreach. I was going to ask if that was the case, but clearly it wasn't. Warm
Yeah.
was much better for you when you were doing your fundraise. And from your experience of actually raising in both the States and the UK, would you say that's the same on both sides, or is it a case of just cold outreach works in some places and it doesn't work in others?
I think it's worse in the US than it is in Europe. And I think
Right.
the reason for that is, and maybe it's not the US more widely, it's San Francisco. And San
Mm.
Francisco is like a fishing town. Everyone kind of knows
Mm.
each other when you get under the couple of layers of you peel back the first layers of the onion. And I think that's kind of like one of the things that is less so in Europe.
Right.
There's two things to be thinking about here. It's a small town, everyone knows each other, so like it's not so difficult to get intros from people. The
Mm.
second thing is like everyone wants to be in San Francisco at the end, or like generally speaking, anyone building in tech that wants to build a unicorn or whatever, they generally end up in San Francisco or have some connection to San Francisco. So because
Mhm.
of that, VCs are spoiled for choice.
Right.
And if you've got someone that's introduced, if you've got your best man from your wedding introducing you to a company that they think you should invest in versus someone that's hit you up on their website and you've never seen them before,
Hmm.
obviously they're going to go for the warm intro because you're basically trading that trust. And you don't have the ability to trade that trust if you haven't gone in via a warm intro. So I think it's worse in the US than it is in Europe. And yeah, again, in comparison, the reason that it's different in Europe is because there's less deal flow. There's a lot of
Yeah.
people looking for good companies, but there's less deal flow, which means people do take cold outreach a little bit more kind of in a more friendly way in comparison to the US.
I mean, that's good for people to bear in mind, and kind of circling back to what we were saying earlier about people having a network and building a network. Not everybody is fortunate enough to be raised in a situation where they
Well,
have a network to tap into when they're walking into their first time as a founder. So given it's clear, warm introductions are really important. What advice do you have for those early stage founders who don't have that massive network to tap into straight away?
I think like there's a few things. Like one, apply for programs like YC where there are less, kind of there's less discrimination against founders. And to be clear, like I hate the fact that this discrimination exists. I wish it was something that I could personally change. And as I say, like once we've turned this company into the company that we want to turn it into, and I'm thinking about my next thing, it will be, I have the goal of going venture side at some point, and I do have the goal of thinking about how do we make it a more even playing field. So feel free to hold me to that 20 years time if I end up going down the route of a lot of others in the space. But I think kind of yeah, the first thing is apply for those sorts of programs because it just helps you build that network more quickly. And again, I understand why this is why the network works because you want to trust with people. So if you can find people that are prepared to take those bets, that's the kind of first thing you can do. I think the second thing you can do is at the end of the day, fundraising, as I say, is all about trust. And people want to be able to trust you, and it's difficult to trust you if they haven't met you before.
Mm.
So the whole purpose is how can you find someone else's trust to trade off of? If you haven't got a network, the best thing you can do is reach out to other founders.
Yeah.
Founders are always happy to help each other. I work with a whole bunch of founders. I do a whole bunch of like just looking at decks for people and giving feedback. And I don't do it because I want to be paid for it, and I'm not paid for it for clarity. I do it because one, it's a learning exercise for me to see kind of what's going on in the market. But two, I wish there were more people like that for me when I was fundraising for the first time. So I think the one thing I will say is generally speaking, founders will help other founders. So
Mm.
the best thing you can do as a first time founder is identify the funds that you want to raise money from or the angels that you want to raise money from,
Mm.
find out who they've invested in, and then reach out to the founders and say, this is what I'm doing. And I know it's annoying because you essentially have to go through a two-step process, but that two-step process means that you can then rely on that founder's trust from
Yeah.
between you and the VC, between them and the VC. And it just gives you a much better footing when you're having that first conversation with them.
Yeah. It makes a difference when there's at least, like you say, there's that person, that friend that has recommended them, so you automatically trust their judgment, or
Yeah.
the investors automatically trust their judgment.
Yeah.
So no, I can see how that's like a huge advantage when you've built up your network to a point that you can go and get those warm introductions. Um, but saying that, what were some of the challenges that you faced as you raised? So I know you closed in 3-4 months, but I'm sure there are still some ups and downs to that process as well.
Yeah, 100%. I mean,
Mm.
building the community, building my own network was hard. There's a lot of noise in San Francisco. It's kind of how do you find the right people to trust? Kissing a lot of frogs, the usual kind of stuff from that perspective that just has to happen. Um, I think, we were still trying to work out what we were trying to build. And I think there is this element of, I think the market has changed. In 2021, pre-seed was genuinely pre-seed. It was let's invest
Mm.
genuinely a good team with an interesting idea. there is
Yeah.
expectation for you to have a little bit more of a product now, and that might just mean Figma mockups, and a
Hmm.
walkthrough. And I think one of the big benefits of having a Figma mockup and walkthrough is if someone doesn't quite understand your product, giving them the ability to essentially see it, just cement some of that stuff for them. So I think in that sense, actually, that's probably been a good thing that the market's gone back that way. Um, but I think yeah, that's kind of some of the stuff we were struggling with initially because we were trying to work out what we were building. We had an idea of the models. We developed these models in kind of other industries and we're bringing those across. Um, but we were still trying to work out what it was that we were building first. And I think that's one of the things that in the early conversations with VCs and angels that we were talking to, we hadn't quite worked out, and that didn't work in our favor. I think the other thing that is difficult to do is we're all busy people, so everyone tells you to basically when you go out to fundraise, start talking to a few people, months before, and then when you're actively raising, block all of your meetings in a kind of 2 week window and do everything back to back. Now you can kind of do it, but generally speaking, that it's a fallacy that everyone thinks you're going to be able to get 8 meetings a day over 2 weeks and close the round 3 weeks later. I think
Mm.
people that can realistically do that are the founders that have raised and exited very large companies because they can call on their
Yeah.
friends for a quick meeting. So I think the big thing is not to be disheartened by the fact that you can't do it all in a 2 week window, and it will take 3, 4, 5 weeks time because people are all over the place. And if you're talking to a partner, well, a partner is one person, and has
Mhm.
a lot of other things on their plate as well. So I think kind of one of the difficulties we had was keeping the round hot at times because we were trying to move as quickly as we could. And that was something that we had to try and think about quite a lot in the sense of how do we make sure we keep this round hot? What do we need to do to keep dropping kind of hints of good things that keeps potential investors excited? Um,
Mhm.
that kind of stuff was challenging, but not unsurmountable.
Okay, that's fair. And I guess that one of the things you want to do is like keep their interest
Yeah,
and kind of like keep the momentum
yeah,
as you start speaking to more and more people. And I guess that is a challenge, especially when people are now raising for like months and months and months. I've spoken
yeah,
to some founders that have been at it for, 6, 7, 8 months, and they've got maybe half the money in the bank and they're trying to close the other half. So for those who are going through those kind of challenges and those battles, how do you keep that spark and that interest with those investors?
regular updates and move quickly, do product releases, show that you're making traction, show that things are moving in the right direction for you. Don't leave them out in the blind and just kind of don't ignore them hoping that they will say yes if you just wait, kind of thing.
Mhm.
Keep them updated with everything that's going on. Keep talking to them about what you're up to. They want to hear this stuff because at the end of the
Mhm.
day, if they haven't said no to you, there's a reason for that. One, it could be because they don't want to be the person that says no, but the reason that they don't want to be the person that says no is because they clearly see something in you.
Yeah.
So if you can keep them up to date and keep them engaged with your company and your product and the round in general, you will find that there will come a point where they will either say yes or no. So
Mhm.
don't be afraid of the no, but keep giving them the information to try and get to the yes or the no.
Yeah, that makes sense. And sometimes no's are good because it gives you clarity and it allows you to say, okay, I don't have to push with that person anymore. You
Exactly.
know, that can save a lot of energy. Getting a no can be quite cathartic. It's just that I don't have to
Yeah.
worry about that person, those group of people.
It helps you refocus your time as well. If you've got 50 people in a pipeline that you're trying to keep in touch, that isn't
Yeah.
a good use of your time. And it's unfair on founders when they are in this position where they have a whole bunch of people that are kind of sat on the fence.
Mm.
Um, so, okay, I guess there is an element of ranking the ones that A, you really want, and B, that seem the most interested and keeping them the most
Yeah.
up to date. But yeah, there's definitely a lot of good in a quick no. When we were
Hmm.
sitting out in San Francisco, any good VC would give me a very quick no. If they were,
Hmm.
they'd say this is the reason that it's a no, and this is why and kind of this is why, but wishing you the best of luck.
Yeah. Yeah, and I think when you have those no's, then it's still worth keeping it in touch with them in the long term because at least you can trust they're going to say what they mean and quickly.
Exactly, and you never know what you're going to be building in the future, you know. It might just not be a fit for their fund. It might be that they don't have any money or they're raising a fund. It might be they've invested in
Yeah,
a competitor. But you know, having done kind of a little bit of angel investment as well, is unfortunately one of the reasons that a lot of VCs give generic no's is because when you try and give genuine feedback, you do get burned by founders who, you know, in the spur of the moment, send an angry email, and it's easy to do. I think one of the things that we all forget sometimes is that founders and VCs often are meeting each other when the founder is at the worst period of their company building,
yeah,
because they're not trying to talk to investors when they're not raising money, even though they should be.
yeah.
So that's kind of one of the things that I try and take into account when I'm on the other side of the fence is, okay, fine, like, you know, people get hot-headed, you know, we all get stressed out. But as a
Mm.
result, because I've heard some horrendous stories, like from
Oh
VCs
no.
and angels of like founders that have sent death threats and all sorts. So you
Oh,
can kind of understand why VCs give you a generic no these days, because it's just
yeah.
so much time to say no otherwise.
Yeah, and I think the challenge is it's almost like what you hear about recruitment, right? Where recruiters don't give candidates feedback because they
Yeah,
don't want to get into what it's a very similar process.
exactly.
It's really similar, and it I think a lot of the time it feels like there's a massive power imbalance
Yeah,
between founders and investors, and
yeah,
so it just means that again in the heat of the moment, founder might get resentful, might believe that they're not giving them a real answer, or might disagree with the reason.
yeah,
Um, and in my limited experience, because I've only been doing this for the past few months, the best thing to do is say, yes or no, great, do you want to be added to our
yeah,
investor updates list to stay up to date with what we're doing?
yeah,
9 times out of 10, they'll say, yeah, sure, email me once a month to let me know how you're getting on.
yeah.
Um, but deal flow can still come from one investor to another. That's another thing to remember. So just because they've said no doesn't mean that they wouldn't know somebody else that could be interested.
Yeah, 100%. So the one caveat to that is I would never let an investor that said no to me that's a perfect fit for my company introduce me to another investor. Just
Mm.
because it's a red flag. In the sense of if you if you get a no from an investor who you wanted to take money from and they say, "Hey, would you like me to introduce you to some of my friends?" Always
Uh,
like the answer is always say no, at least in my opinion. Just because if I was an investor that was being introduced to a company um, by another investor, my first question will always be, "Well, are you investing?" And if the answer
yeah,
is no, my question is like, "But why aren't you investing? Why are you asking me to invest?" So
yeah,
that's one of the things to definitely take into account. But I think they're the two big things to think about here is like, as I say, trust the no, don't trust the reason. Like they said
mm,
no and move on. But most importantly, don't take it personally. Like this is a
yeah.
game, it's a sales game. You know, it's if every salesperson got offended at every no they got from every kind of bit of outreach they did, they would be very, very resentful people.
Yeah. Yeah, I think there'll be no one in sales at that
Yeah, yeah,
point.
100%.
Um, but one of the something slightly different, but one of the big challenges that a lot of founders face is balancing building and fundraising at the same time. It can literally feel like you're being pulled in two opposite directions because on one hand, you're speaking to investors, obviously it's a necessity, sucks up a huge amount of time.
Yeah,
Then you want to kind of like pour your all into the product
yeah,
because that's ultimately what will land you the investors in the first place.
yeah.
So how have you balanced like fundraising with running the business?
Not the best. I think we initially set out to raise the round quickly and then go back to product, but because the market wasn't as, I guess, as buoyant as it has been in the past, it's taken longer than we expected. So we ended up kind of needing to focus a little bit on product as well. In the perfect world, you line everything up and you have at least two co-founders in the company, so one can focus on product and the other can focus on
Mm.
fundraising. Um, I think that's kind of like the first good thing you can do. Generally speaking, like raise the round as quickly as you can so you can focus on product, but don't neglect product completely because at the end of the day, VCs want to see how things are progressing with the product. So if you aren't doing anything because you're fundraising the whole time, then it's going to make it very difficult for them to say yes because they begin to question your ability to execute. So
Mhm.
um, I think the best thing that you can do is think what have kind of a roadmap of things that you want to get built that aren't so taxing necessarily or don't require the same level of build, um, that you can use to kind of help get you towards that close of the round.
Mhm.
Use them. Um, Use them and use them to constantly update your investors, keep them updated with kind of how things are moving along. And then, kind of, yeah, try and close the round as quickly as you can. I mean, there's no real good answer to this one, because you can't ignore product completely, but at the same time, fundraising takes up your whole life, when you're doing it.
Yeah, I mean, I guess the one thing to remember is, like I say, don't neglect the product.
Yeah,
Um, at the neglect the product, and do your best to create balance. It won't always be balanced. There'll be some weeks where
yeah,
your calendar is full of calls and you just got to do it.
yeah, exactly.
The weeks that it isn't, then throw yourself into the product.
100%. And as I say, like, fundraising is a sales process. And like at the end of the day, at some point, you're going to be doing a lot of sales as well. So, it would be the same way of if you are, I mean, all companies should do founder-led sales to begin with. So, if you're, going to be trying to bring on customers at some point, then it's exactly the same. How are you going to manage product when you do sales? Do the exact thing when
Mm.
you're fundraising as well.
Yeah, no, that's true. Trying to create as much of that balance as you can is super important. Um, and on kind of like last question around fundraising, but traction and sustainable growth.
Yeah.
Those are the two big things on investors' minds at the moment. We've had, a few, well, probably past a year or just over a year, where there have been lots of layoffs, big companies that raised huge amounts, kind of growth at all costs situations, which led to lots of people losing their jobs, money being lost, and investors are now trying to avoid that,
Yeah.
you know. So with this kind of shift of mindset to more traction and like growth and doing that sustainably, how did you navigate those conversations? And when you were speaking to investors, especially given that you were very much like, we are building the product, we have 60 potential customers, it's early days with revenue. How did you manage to do that?
I think, like, I mean, the approach that, I mean, the company that we're building is very much focused around sustainable growth. The reason that we started is one of the big tailwinds in our favor is the fact that the market has gone towards sustainable growth in the sense of we have to think about product experiment differently. In the past, we would spend weeks and weeks, if not months, thinking about product experiments, throwing money at it, and then seeing what happens. And now we're in
Mm.
the position where we still need to grow products, but we need to think about, like, yeah, we need to think more carefully about the experiments that we're running and when we're running them. So that's kind of like one of the first things that worked very well in our favor. Um, Traction wise, I mean, we approached this company slightly differently. We said, this is our third company together, myself and my co-founder. So we've built two companies together before this one, and we've gone through highs and lows of building companies. And generally speaking, it always comes down to like how well is the bottom line, like how good is the bottom line.
Mm.
We said to ourselves with this company, we do not want to build another company unless we're able to bring on a customer from day one. So we didn't even approach this. So before we started kind of building this company, we were looking at some of us. One of them, I was doing contract work. Olivia was looking at roles.
Mm.
We kind of said, like, we didn't say we're going to build another company. It just kind of happened by accident, but it happened by accident because we said if we're going to build another company, we want to be making revenue from day one.
Yeah.
I think that's kind of like one of the things that I would be saying to founders right now when thinking about kind of sustainable growth and traction and all of that kind of stuff is I think this is a better way to be fundraising and building product now. It's kind of gone back
Mm.
to the point where there are two types of companies that are being funded. There are the deep tech innovation plays where there are big markets that could be built if you put it off successfully. And then
Mhm.
there's almost kind of growth capital. I mean, it's not growth capital, but it's money that allows you to grow the existing base of customers that you've got.
Yeah.
That's the way that I think about fundraising now. I'm not thinking about fundraising in the sense of I've got an idea and I want to raise some money so I can go and build it. I think
Mm.
investors now expect you to have some form of what that product looks like before you try and essentially raise money. Um, So yeah, take into account what your revenue model looks like, be clear about how you're going to achieve it, make sure it's kind of achievable and realistic. Um, those are kind of the things that I'm thinking about when trying to think about, yeah, sustainable growth and making sure that I've got some level of traction before I think about raising money.
Yeah, that I mean that's all fair, especially one of the things that we can't do is change what's happened. And you know, the like I said, the world has financially been on fire for the
Yeah,
past couple of years. You can't fight against those experiences and the things that people have seen. So, you know, the best thing you can do is prepare for that situation.
100%. And I don't think the world's going to get much better anytime soon. I could be wrong, but I mean, we're walking towards two of the largest elections in the Western world, which is the US and the UK elections.
Yeah.
We've got, I mean, the thing that got me is 2024, 40% of the world's GDP is voting this year, which is terrifying, especially when you look at the way the world which is going, which is more insular, more nationalist.
Mm,
We're moving away from cooperation and towards kind of this individualistic mindset, which countries,
mm,
people within them seem to have. So what's going to happen with the markets, who knows? But if I was a
mm.
betting man, the fact that we're seeing so much investment going into defense and other areas, it's quite clear to me that the wider world and the governments that run those countries in the wider world are thinking quite seriously about the potential for some sort of maybe not war, maybe some sort of conflict, which isn't going to do the markets any well. So taking that into account is something that founders should definitely be thinking about.
Yeah, it's important to try and think ahead as much as you can. And, you know, one of the good points that you made earlier about when people are thinking, okay, what am I raising? How much of my company am I going to give away? What you want to do is start with the end result and reverse engineer that and be
Yeah,
like, actually, at the end of this, what do I want to end up with?
yeah,
And what's the best way for me to go about getting there?
yeah,
You know, when you go through that process of reverse engineering it, you can then think about, okay, what is the world going to look like? What
yeah,
could it look like? Because you can't predict that. But what could it look like in the next few years, and how will it affect this plan?
exactly.
But last question.
Yeah,
If you could go back and do it all again, given you've done this a few times as well, so you have actually gone back and done it again, but if you
yeah,
could
yeah.
if you could start this one all over again this round, what would you do differently, if anything?
I think I would have spent more time building the community. I don't think I gave myself enough time to build out the community as much as I'd have liked. I think we could have got the round done quicker. Um, so I think that's kind of like the main thing that I would have been thinking about. I think the second thing is, we had a wait list, but we didn't have customers before we raised. I think this time around we would have made sure that we had, I don't know, like 2 to 3 paying customers,
Mm,
proof of the fact that there are multiple people that want to pay for it, in
mhm,
top of a wait list. I think it just would have made the raise much easier for us, and we maybe would have got a slightly better valuation. Like I think, I'm happy with the valuation that we got, but we may have got a slightly better valuation. I think for me, the things that I was thinking about is how do I get this round done as quickly as possible? How do I take
mm,
into account other things like, where am I going to be based in the world and kind of
mm.
visas and all that sort of stuff. So like all of this was kind of things that I took into account. So would I change anything? Yes, I would have just made it. I would have taken more time to build my network. But
Mhm.
given that we were moving out to the US, we didn't necessarily have that time because we had to think about visas as well. So yeah, that was kind of one of the approaches that we took with, that's kind of one of the approaches we were forced to take just because we didn't have a choice in that perspective.
Yeah, I mean that's fair. And I think retrospectively there is always at least one thing
Oh,
that
100%.
people will change.
Yeah, yeah, and like that, yeah, I could list 110 small changes that I definitely would have made, but yeah, there's a whole load of things I would have done. Like one of the mistakes I made one time was I had, and this is just a tiny little thing, but we use DocSend for everything, and I automatically put an expiry on the like things because I assumed that people would say no, and I just kind of said to myself, well, I'll give them a month, and then if we haven't had a no or a yes within a month, they're probably not going to be interested. I
Mm,
distinctly remember a day where I just received, it had to be nearly 100 emails in about a 2-minute window, of
mm,
multiple people trying to access the pitch deck at the same time. And it was because
Oh,
an investment committee for a fund that we were talking to was trying to access the deck to discuss it internally, and the link had
oh,
expired. Now,
oh.
fortunately, I woke up in time and was able to just slyly like grant access again. But yeah, that's probably one thing I would have changed to prevent my stress levels from flying through the roof in these few minutes. And there are a whole bunch more that I could definitely list off.
That's a great one to end it on though. I think something for people to remember because so many people are using those different tools and
Yeah,
systems to send decks out in links now. I use Slidebean
yeah,
for my pitch deck, and you can either make the links expire or say
yeah,
like only this person has access. So yeah,
yeah.
something for everybody to take away. If you give them a
100%.
link, don't close the link.
Yeah, yeah. Or if you do, just like remember that, like, don't do it until you've got the no, because that is a problem.
Yeah. Wait until you've received an answer before you
Yeah,
update the link,
yeah,
guys. Just remember that one. So I mean, an hour has gone by very, very quickly.
100.
Uh, so thank you so much, Tom. That's been great to hear about all of your experiences, especially because you've raised in two of the, kind of like the biggest parts of the world when it comes to like fundraising.
Yeah.
Lots of really great actionable tips that you've shared with people. So yeah, just thank you
No worries.
for
Happy.
it's been great. And so to everybody who's listening, thank you for making it all the way to the end. And hopefully this has been super useful for you. If you've enjoyed it, don't forget to subscribe. And also make sure you share it with other people that are fundraising, that are thinking about fundraising, so that they can learn from this too. We will add links to where you can find Tom online, so you can connect with him if you want to. And we'll also add links to anything else that was useful that was referenced in the chat today. So a big thank you, like I said, to everybody who's listening. Another big thank you to Tom.
No, thank
And
you.
yeah, we'll see you on the next episode.